One of the most common questions I get from real estate investors is, Ryan, how should I structure my entities for my rental properties? And I get it because there's a lot of conflicting information out there. You've got people on YouTube telling you to put every single rental property into its own LLC. You've got people saying you need a trust. Some people are saying register in Wyoming, while others are saying Delaware. And nobody's walking you through the full picture. I'm Ryan Carriere. I'm a CPA who works specifically with high-income earners who are looking to use real estate tax strategies to pay less tax. And I've set up this exact structure with hundreds of clients. I also posted about this exact structure recently on LinkedIn and had several attorneys in my network confirm this is a great structure for real estate investors. But what I'm going to walk you through is not technically legal advice, but it is a structure that I commonly use and is implemented with the help of my clients' attorneys. So in this video, I'm going to walk you through the entity structure I use with my clients, layer by layer, so you understand exactly what it looks like, why each piece exists, and how to set this up the right way. So let's start at the bottom of the structure, which is the LLC that holds the investment property itself. This is the first thing that most investors think about when they hear the word entity structure, and for good reason. The property's LLC is your liability shield. If something goes wrong at one of your properties, a lawsuit, a slip and fall, whatever it might be, that LLC keeps the liability contained to that asset compared to other assets. And one thing that commonly gets missed here is you actually need to have the property's title deed in the name of the LLC. You cannot just set up the LLC and never use it, have it not use the name of it. But here's where a big question comes in, and I get this one pretty consistently. Should I put multiple properties into one LLC, or should each LLC have only a single property? The general recommendation is one property, one LLC. That should generate the most separation for maximum liability protection. In contrast, if you have two properties in a single LLC, you now expose the equity of both properties in that one LLC. Separated LLCs are going to isolate the different assets from lawsuits and slip and falls. That said, there are some situations where grouping a couple properties into a single LLC can make sense. It just depends on the number of properties, the state you're in, and the cost of maintaining multiple LLCs, and overall the equity in each property. Each LLC can come with filing fees, registered agent fees, potentially its own bank account. So there's a cost-benefit conversation that usually happens with an attorney. The important thing to remember here is that an LLC is purely for liability protection. It does not save you on taxes. Whether the property is held in an LLC or in your personal name, the taxes are treated the exact same. And if you've been watching some other tax influencers out there on YouTube or TikTok or Instagram, you probably have this backwards or confused. So I'm here to try to set this straight. And this is a big misconception I see too, that having an LLC is going to include more expenses and more deductions simply by paying for some of your expenses through a business bank account because you have an LLC. That is not true at all. I even had one person tell me that as long as they have their expenses running through an LLC, that even though they had personal expenses like paying for daycare or paying for a trip for a vacation with their family, that as long as it went through the business's bank account, having that LLC, and now all of a sudden made it as a tax or business deduction, even though it had nothing to do with their business. Now, what I'm walking you through in this video is the same structure I use with my clients at Carriere Tax Consulting. And entity structure is just one part of this. We will talk through your full tax strategy, depreciation planning, material participation, cost segregation studies, all of it. If you're a high-income earner who's either considering buying your first rental property or already have investment properties, and you want this set up correctly from the start, click the link in the description and book a call with me and we'll make sure that we discuss this together. All right, let's keep going. So now we've got the property LLC, and now we're gonna move up a layer. Above the property's LLC, I recommend establishing a holding company that owns all of the property LLCs below. You could think of it like this. At the bottom, you've got your individual property LLCs, and they flow into a holding company that sits above it. This creates an extra layer of separation between you and the properties, and this is where state selection of that holding company becomes important. So keep in mind, the holding company does not own your properties directly. It holds the ownership of the LLCs that do below it. I typically recommend registering the holding company in the state of Wyoming Because it's one of the most business-friendly states for LLCs, it provides additional anonymity, there's no state income tax, and a very minimal license fee on LLCs. They have strong charging orders, meaning if someone gets a judgment against you personally, it's much harder for them to reach the assets inside the LLC within the state of Wyoming. A lot of people ask about Delaware, Nevada, other states, and they each have their own advantages. But for most of my clients, Wyoming seems to be the better fit and the primary recommendation from attorneys for real estate holdings. The privacy protections and low maintenance costs for Wyoming seem to be a typical winner when it comes to which state to select. All right, so now we move up one layer. This is the top layer. Above that holding company, I recommend a revocable living trust that is going to own that holding company LLC in Wyoming. And I know when people typically hear the word trust, they immediately think it's only for something the ultra wealthy do, but that's really not the case. A revocable living trust is actually one of the most practical uses for real estate investors, and here's why. A revocable living trust is going to allow your assets to pass from you to your beneficiaries without having to go through the time and the cost of probate. That probate time and cost in and of itself could cost tens of thousands of dollars. Probate is a public court process that can take months, if not years, depending on the complexity and how much are in the estate. It also exposes your financial details to the public. But with a revocable living trust, your real estate holdings transfer smoothly and privately to where you want them to go. Revocable is going to mean you maintain full control. You can change it, you can update it, add or remove assets, or do whatever you need to. And this is a key distinction between an irrevocable trust, which is going to lock things in and require its own tax return amongst many other administrative items. Most of my clients with where they're at today do not need an irrevocable trust right now. For real estate investors, there may be a lot of buying and selling. A revocable living trust is going to give you that flexibility to move assets in and out without any sort of tax implications, while still giving you that estate planning benefit to remove the time and cost of probate in the future if you were to pass away suddenly. Now, one last thing here that I want to comment on is if you're married, should we have a joint trust or should each spouse have their own trust? If you have a joint trust, all of this structure I've just recommended is going to mean all of your rental properties can continue to go on your Form 1040, your individual tax return. However, if you're basically going to have two individual trusts, you and your spouse, now you might be subject to a partnership tax return based on all the withholdings in that holding company, LLC, within Wyoming. Now, for most people, that partnership tax return is unintentional, but until you understand some of these nuances and differences, you might unintentionally have a partnership tax return, which is going to increase your fees for tax preparation on an annual basis moving forward. So as long as you can achieve your legal protection without needing to have a partnership LLC, then I would recommend you have a joint trust, or if you're single, you just have your own trust, obviously. Point is, be careful. Having a joint trust is what I would recommend for you and a spouse. So here's the full structure one more time. You are at the top. You have a joint revocable living trust. You have that own a holding company LLC in Wyoming, which is going to 100% own the rental property LLCs below that. Each layer has their own specific purpose: liability protection, privacy, asset protection, and then estate planning, all while keeping your fees as low as possible. All right, I hope this was helpful and cleared up a lot of questions you may have had about entity structure. If you're looking at buying an investment property and want to know what to do before you pull the trigger, go watch my video on the 3 things to know before you buy your next investment property. I'll link it right here on the screen for you, and I'll see you in that video next.